Dirty dealings, corporate battles, consumer woes. This is Evening 5. Sapura Energy announced on Friday the impending departure of its chairman, Datuk Muhammad Azlan Abdullah, and Chief Executive Officer, Datuk Muhammad Anwar Taib. Azlan will step down from his position on January 31st, 2025 due to other personal commitments, according to the oil and gas engineering firm's boss filing. Azlan was appointed to Sapura Energy's board in October 2019 and promoted to chairman in May 2022. Azlan has been on a leave of absence from Sapura Energy since June 26 this year. At the time, the company said the leave was to allow him to focus on ongoing investigations by the Malaysian Anti-Corruption Commission concerning a matter unrelated to the firm. Meanwhile, Anwar will step down from his role as CEO and Executive Director on December 31st, 2024, after serving 3 years in the position since March 2021 to pursue personal endeavours. In a separate statement, Sapura Energy announced the redesignation of interim chairman Shahin Farouk Jamal Ahmad to group chairman, while Sapura OMV Upstream CEO Muhammad Zamri Jushol will take over as Group CEO. Sapura Energy has also appointed Muhammad Nasri Mehat as officer in charge in the interim until Zamri's tenure begins on March 1st next year. Muhammad Nasri is currently the CEO of Operations and Maintenance and Senior VP of Group Quality, Health, Safety and Environment. Shahin said that the group wishes to extend its deepest gratitude to both men for their exceptional service and wish them the very best in their future endeavours. He added that Sapura Energy's existing business plans and restructuring efforts will continue to be executed under the new leadership. Sapura Energy's current largest shareholder is Pemulihan Nasional's unit trust fund Amanah Saham Bumiputra, which holds a 36.9% stake. Public Bank, Malaysia's third largest bank by assets, saw its net profit for its third quarter improve by 12% year-on-year to 1.91 billion thanks to operating income growth. Net interest income rose 5% year-on-year and income from Islamic banking was up 6.5%, while non-interest income such as fees and commissions climbed 18%. Group Managing Director Tan Sri Teh Alek said that Public Bank continues to see opportunities for business banking growth amid improving economic prospects. However, he stressed that the bank would remain prudent and focus on strengthening its fundamental resilience. In the third quarter, the bank has written back only 20.45 million in allowances for impairment on loans, advances and financing. Public Bank's gross impaired loans ratio stood at 0.6% as at the end of September. Meanwhile, the bank's common equity tier 1 capital ratio came in at 14.3%. Total loan portfolio expanded at an annualized rate of 5.2% to 414.5 billion ringgit, with domestic loans rising 6.2% annually to 390.1 billion ringgit. RHB Bank saw its third quarter net profit jump 28% year-on-year to 833.2 million as sharp currency gains of 659.9 million boosted non-interest income. Net interest income rose 8.8% year-on-year to 996.8 million, while other operating income more than doubled to 1.045 billion thanks to those hefty net forex gains. Excluding the net forex gains, the bank's other operating income would have been 394.1 million ringgit. No dividend was declared for the quarter. Quarterly revenue increased by 7% to 4.51 billion from 4.22 billion previously. According to the board's filing, return on equity also improved to 9.8%, up from 9.6% in the first half, reflecting the bank's stronger financial performance. Total income increased 11.3% year-on-year to 6.4 billion, driven by growth in both net fund-based and non-fund-based income. As well as that, cost-to-income ratio improved to 46%, down from 47.1% a year ago, while gross loans rose 2.3% year-to-date to 227.5 billion ringgit, driven by growth in the group's community banking and commercial segments. Looking forward, RHB expects continued stability in Malaysia, with gross domestic product growth projected at 5% in 2025 and the overnight policy rate anticipated to remain at 3%. RHB said that it will stay agile in navigating the evolving landscape, leveraging digital innovation and sustainable finance to drive sustained quality growth. Hextar Industries said on Friday it has signed an agreement to bring in Chinese coffee house chain Luckin Coffee to Malaysian shores. The company will have the exclusive rights to develop, open and operate coffee shops under the Luckin Coffee brand nationwide in Malaysia. The rights would be for 10 years, with possible renewal for 2 successive 5-year terms, according to the BOS filing. Hextar Industries major shareholder Dato' Eddie Ong Chu Meng said that the company plans to expand Luckin Coffee aggressively across the country. The master development and operating agreement signed by Hextar Unit Global Aroma with Luckin Coffee Holdings Singapore follows a report by The Edge in June that Luckin Coffee plans to partner a Bursa Malaysia listed firm for its Malaysian debut. Founded in 2017 and headquartered in Xiamen, Luckin Coffee operated 21,343 stores globally as of the third quarter, where in the third quarter alone, the company opened 1,382 new stores. For its first foray into Malaysia, the plan is to open the first store by the first quarter of 2025. The entry of Luckin Coffee comes at a time of heightened competition from a rising number of coffee brands and outlets competing to fill the gap left by Starbucks, which has faced protracted consumer boycotts due to Middle East tensions. Ong said that by bringing this franchise to Malaysia, it will not only widen its portfolio but also tap into the thriving food and beverage market here, making it a highly worthwhile investment for both Luckin Coffee and Malaysian consumers. Padini Holdings said that the retail business remains tough amid rising cost of living after the apparel company reported a sharp drop in profits. Net profit for its first quarter of 2025 plunged by 57% year-on-year to 11.52 million due to currency loss, higher staff costs and depreciation. Revenue for the quarter was fairly flat, improving by 1.3% year-on-year from 388.2 million to 393.1 million ringgit. Padini reiterated that it would continue to implement measures to control costs, optimize working capital, preserve cash and streamline the operations to minimize any adverse impact. Despite the softer numbers, Padini still kept up dividend payouts with a second interim distribution of 2.5 cents per share. Despite the potential challenges, Padini said that the group was optimistic, noting that there was an expansion in the number of stores during the first quarter.